Most people think investing is about picking the right shares, but in reality, how you divide your money matters far more. Two people can invest the same amount at the same time and end up with very different results, simply because their asset allocation is different. In this video, I'll explain what asset allocation actually means, why it matters, and how to make sure yours fits your goals and your comfort with risk. Before we get started, just a quick note, this video is general information only and doesn't take into account your personal circumstances. It shouldn't be considered personal financial advice. If you'd like advice specific to you, please seek professional guidance. Asset allocation is simply how your money is split between different types of investments. At the most basic level, it's the mix between growth assets and defensive assets. Growth assets include things like shares and property. They have higher long-term return potential, but their value can move around quite a bit in the short term. Defensive assets include things like cash and bonds. They tend to move less, but they also grow more slowly over time. That's really the core idea. Your allocation determines two things: how much your money might grow over the long term, and how much it might fluctuate along the way. If you tilt heavily towards growth assets, you're likely to see stronger long-term returns, but also experience larger ups and downs. If you tilt more towards defensive assets, your balance will likely move less, but your long-term growth may be lower. There's always a trade-off. More growth potential usually means more volatility. More stability usually means slower progress. It's not about good or bad, it's about balance. Now let's talk about why this matters so much. Research consistently shows that the biggest driver of long-term investment outcomes isn't share picking, and it isn't market timing. It's your asset mix. To put that into perspective, imagine a 40-year-old with $150,000 in super, earning $100,000 per year. That's roughly $12,000 in employer contributions going in each year. If that portfolio earns just 2% less per year because it's structured too defensively, by age 65, the difference can be close to $500,000. That's not because they picked the wrong share. It's because the overall mix didn't give the money enough opportunity to grow. Small percentage differences compound significantly over decades. The asset allocation compounds, but growth alone isn't the whole story. Because chasing higher returns without ever considering your tolerance for risk can backfire. If a portfolio is too aggressive for your comfort level, the ups and downs may cause stress, and stress can lead to poor decisions. This is where behavior becomes important. As humans, we feel losses more strongly than gains. Losing $100 tends to feel worse than the satisfaction of making $100. That's not a character flaw, it's how we're wired. So when markets fall and your balance drops, the emotional reaction can be strong. If your asset allocation exposes you to more volatility than you're comfortable with, you're more likely to panic and sell at the wrong time. And selling during downturns is one of the biggest long-term mistakes investors make. It locks in losses and often means missing the recovery that follows. A suitable asset allocation helps reduce the chance of that happening. Not because it eliminates volatility, it won't, but because it keeps your portfolio aligned with your ability to tolerate it. The goal isn't to avoid market movements, it's to structure your investments so you can stay invested through them. There are a few common mistakes I see when it comes to asset allocation. One is copying someone else. Your friend might be comfortable with a high growth portfolio. That doesn't mean you should be. Another mistake is chasing last year's top performer. Markets rotate. What performed best last year may not perform best this year. Switching allocations based on short-term performance often leads to disappointment. On the other side, going too conservative out of fear can also be costly. Sitting heavily in defensive assets for decades may feel safe, but it can significantly limit long-term growth. The key isn't aggressive or conservative, it's appropriate. Appropriate for your time frame, appropriate for your goals, appropriate for your temperament. So how do you apply this in a practical way? Start by checking your current mix. Log into your super account or investment platform and look at how your money is allocated between growth and defensive assets. Then ask yourself a simple question. If markets drop 20% tomorrow, how would I respond? Would I stay the course? Or would I feel pressure to move everything to cash? Your honest answer tells you a lot about whether your allocation matches your comfort level. Next, consider your time frame. Money needed in the next few years should usually be structured differently from the money invested for 20 or 30 years. The longer your investment horizon, the more time you have to ride out volatility. Finally, think about your goal. Is this money meant for long-term growth, income, short-term security? Your allocation should reflect that purpose. There is no universal best mix. There is only the mix that fits you. Asset allocation isn't complicated. It's simply the balance between growth and defensive assets. But it has an enormous impact over time. It influences how much your wealth grows, how much it moves, and how comfortable you feel along the way. The right allocation helps you stay invested through market cycles. And staying invested is what allows compounding to do its work. You don't need to adjust your portfolio every month. You don't need to react to every headline. You need a structure that makes sense for your situation and the discipline to stick with it. If you want to implement this properly, I help Australians structure this every day. Details are below. There's no perfect allocation, there's only the one that fits your goals, your time frame, and your tolerance for risk. Asset allocation isn't the most exciting part of investing, but it's the foundation, and foundations matter.